Let's start with the markets. Today's early rebound has been nearly completely wiped out, but we're gyrating. Joining us now is Wilmington Trust Chief Investment Strategist Megan Hsu and Barclays Head of U.S. Equity Strategy Venu Krishna. Welcome to you both. Megan, what do you do here? What do you make of it? What's going on?
Yeah, this is tough. I mean, it's a tough market, highly volatile. I think the answer that maybe nobody wants to hear, because it's always tempting to want to do something, is that you kind of have to buckle up and go along for the ride. We have basically two very distinct paths we could take here. One that could result in significant negotiations and much lower barriers to trade. That could be a very strong long-term positive. The other one could be a more difficult road if these tariffs stay on for any length of time, really. And so I think we're just watching to see what signals we get from the White House. For now, we are allocated neutral to equities. Thankfully, we took a little bit of risk off the table early this year, seeing valuations as having climbed. But at this point, I think you have to wait a little bit longer. Our base case is for, at this point, a recession, assuming that the tariffs stay on. But obviously, that could go either way. And we're sort of minute by minute with the headlines.
Yeah. And Venu, I'm just watching, we were showing it a moment ago, watching that 10-year yield climb. We're almost at 4.25.
Yeah, so I think we have the worst combination right now. And inflation expectations have gone up. Recession probability has increased quite significantly. And the 10-year also has reversed quite sharply, right? Generally speaking, that's also not good. But we're in such an interesting dilemma that if the 10-year collapses as well, that's not good for the equity market. So I think any way you turn, it's safe to say that the next 3 to 6 months are going to be tough till ultimately this tariff policy issue gets resolved. And I think that takes time.
So, Venu, it's Brian Sullivan. Are we at recession stock levels then? And if not, what is the right metric, valuation, multiple for the S&P 500?
Good question. So I think we have significantly derated. So if you look at the S&P aggregate multiple, it's come down about 4 handles. The nearest sort of comparable example you can see of a significant derating was in 22, which was a big tech-led sell-off. So I would say compared to that, we are about roughly 3/4 of the way. But in terms of recession, the probability has increased. But even now, I think what we are looking at is a shallow recession. I don't think we are priced for a very deep or aggressive recessionary environment. So I think if that were to happen, then you could argue that there's a lot more to go. So I would argue that pockets of the market do look interesting right now, but it could be choppy at this point in time.
Yeah, you said, Megan, that you were neutral to equities, the base case, recession. What does that mean, neutral to equities? I would imagine your clients, our viewers, our listeners, just kind of wondering, what do I do now?
Yeah, well, neutral to equities means you're fully invested. So we are recommending that you stay fully invested. Our clients are diversified, so getting some benefit from, certainly not today, as you point out, the 10-year, but some benefit from defensive assets like fixed income and cash. I think that we're kind of caught in this middle ground. You posed a great question just now in terms of recession, and I don't think that we are priced for either a mild recession or a more severe recession, but I do think that it's a little bit too late to sell at this point, assuming your time horizon is about a year. We've looked at recessions that are not associated with the popping of a bubble, and the drawdown is anywhere from 20 to 30%, but you tend to see a recovery from that trough level in less than a year. So I think it's just about being patient here, and we don't see signs of a bubble, not in credit. Household balance sheets are pretty good. Corporate balance sheets are in good shape, certainly not enough to withstand the magnitude of the tariffs that we've gotten. And then I also reject the idea that tech is a bubble. So I think that there is just a need to be really patient here as we wait to see if we are going to move into a recession, if it would be mild, and then hopefully recovering again in that typical time horizon.